Hi, today I am going to review 5 stocks and explain their financials and what to look for in their financials when you pick any stock. I am not a certified financial advisor, and therefore I am not advising you to buy these stocks, and I am just showing you how to review a stock and decide for yourself whether you should buy it or not. On top of that, I am strictly only reviewing them for financial information. There are 2 components that I do when I go and look for a stock to purchase, or I'm making an investment, whatever it is. There are 2 things that I do and I recommend anybody do when they go and look for investment. The first thing is to review the financials of whatever you're looking to purchase. The second is to decide whether you think that this company or entity, whatever it is, this investment is a good investment going forward, whether it's going to perform well. And you could be looking at the underlying product. You can be deciding whether it's a service, a product. You can look at that service or product and decide, do I think that this service or product is going to be doing well in the future? So I'm going to show you 5 different stocks that were asked about in the last video when I created a video on really how to research stocks by yourself. Okay, so the first one I'm going to review is Canopy Growth Corporation. I wasn't asked for this stock specifically, but they asked for something in the cannabis industry, which is a pretty popular industry. In the past few years, people are all excited about it because it's becoming legal. And here is one of the bigger companies. It's actually a Canadian. So here's the stock price. And if you need to know anything more about this, you can go to my previous video, which I'll put a link to, that really goes into all of these items and explains to you what you're looking for. This is really just an overview. So the price right now is $16.48, and their 52-week range is $9 to $44. So they're at the lower end of their 52-week range. They don't have a PE ratio because their earnings per share, they have a negative income, so they're losing money, right? Well, at least as of the last year. And here's a chart of their stock, and I'm going to show you a chart of their stock. And okay, so here's their year-to-date. Right now I'm going to show you the pre-coronavirus value because that's kind of important right now. You see here is where their stock was before the coronavirus news started coming out, and then it went all the way down, and here it is today. Now, when you're buying any stock, you should look back and see how it's done over the past couple of years. So here's a 2-year chart, and as you can see, it was selling off way before today, way before coronavirus hit, which is something that you should be very wary about. You see it was up here in the 40-50 range, and then it went all the way down, it went back up, and then it went all the way down. And that is definitely something to be nervous about. When you see a stock do that, you want to look at the news and really understand as to why that. So their most recent financials, full year financials, was almost a year, it was over a year ago. So this is not very indicative, but it still shows the last few years, as you can see right here. And you can see there's steady growth in revenue. Their cost of revenue is it's a pretty healthy margin they have. Their gross margin, which is their revenue less their cost of revenue, or the directly relatable costs, is very healthy. That means if they scale up their operations, they're going to be doing well. but their operating expenses are very high, mainly because they're a newer company. That doesn't necessarily mean a bad thing that they've had a loss. That could just mean that they're growing and they have a lot of expenses. But you need to understand what these expenses are in order to make a sound investment decision as to whether you should buy the stock or not. And then their net income is down here, and it's been going down every single year. That's mainly because of their large operating expenses. So then I'm going to look at it quarterly real quick because that shows them more accurate. Here's the 12/31, and you see also over here it's been growing pretty nicely, their revenue at least, and in the last quarter they still had a net loss of 120, that would be 120 million because it's in thousands. But you could see that over the last few quarters, it's going towards a net income. And so then I'm going to come over to their balance sheet, and I want to show you something else, another website that I use. It's called FinViz, and I'll put a link in the description, and they have a screener, and you can put a stock symbol in, and it'll tell you all sorts of different things. There's different indicators and things that they follow for each stock, and I have a bunch of indicators for the stocks that I'm going to show you today. And actually, so because Canopy is kind of a newer company, they seem to not have all of the indicators that I wanted to show you. But I'll explain to you on the financials what you're looking for. The main thing I look for, especially nowadays, is that liquidity, that they are able to pay off their debts. So you want to look at their current assets, which is they have that'd be $5 billion in current assets. 4.5 of that is cash, and then their current liabilities is 411 million. So they have a very good amount of cash, and they're okay financially. They can pay off their debts, so they're not at risk of going under anytime soon. So, and that's a review of the first stock that I wanted to show you. The next stock is Lockheed Martin. Lockheed Martin has been around for a very long time. They sell basically government. They have government contracts mostly for military planes, missiles, all sorts of other military equipment. And they obviously at this time they probably don't have as much of a problem with COVID-19, and so their stock is actually doing pretty well. And I'll show you a little bit about their financials. So they're trading at $388, and they have their 52-week range there is 266 to 442, so they're kind of right in the middle of their 52-week range. I guess they're down a little bit due to COVID-19. Maybe they're worried about people, how many employees they have working, and whether they'll be able to produce everything they need to produce. Their PE ratio is 17, which means their price is 17 times their earnings, which is their earnings per share is $22 per share. And they also have a dividend, so they have a 2.47% dividend every single year. Well, at least this year. That's their forward dividend and yield. Here's a little show of their financials over the last couple of years. You could just see the chart over here. They're growing over time, and they have net income as well, and that's growing a little bit each year as well, and that's a very good sign. And then we'll come over here to the chart, and their chart is okay. so here's the 2-year chart, and they're going up very nicely. This means the dividends, and you could see what their dividends were. They were going up very nicely up until this year. They went down sharply due to COVID-19, but they have recouped most of those losses in the last month or so, and they're not at their highs, but they're not far from their highs. First, I'm going to go to the stock screener over here on FinViz, and I'm going to show you some numbers. These numbers that Yahoo, you can't really get on Yahoo Finance unless you get their premium version. So I'm only going to show you what you can get for free out there. FinViz is free. You can subscribe to them as well and get more data, but a lot of this information is free. And so you see over here they have Lockheed Martin, and I'll show you some important numbers that you can find on their website. One of the most important numbers is the current ratio and quick ratio, which I showed you before on Canopy stock, is the ratio of how much cash and the current ratio is how much current assets they have to current liabilities, and the quick ratio is the current assets that you're able to have quickly. Like cash, you have cash, you can use that quickly. Not all current assets you can immediately get if you needed it. So quick ratio is a better indicator, but they have 1-to-1 ratio of debt to of current assets, liquid current assets to current liabilities, which is good. It means that they can cover their short-term debt. And then another few numbers over here, and I showed you these numbers as well on the financials, but this is it's really nice to see it here in percentages. It's easy to look at. So this shows their gross margin, which is their revenues less their cost of goods sold, which is a very good indicator of how they're basically, if you sell an item for $100 and your cost to sell that item are, in this case it would be $77, let's say, and so they have that $13 left to cover their all their other expenses, their general administrative expenses, and that basically tells you that how much they have left to cover those expenses. So if they made X amount more products, you would know that they would be making X amount more net income, assuming their general and admin expenses didn't go up. That's not to say that they won't, but it's basically an indicator of how well they're doing on their product that they sell. Now, the operating margin is that same amount less their general administrative expenses, and the profit margin is including interest and taxes and other items. So that's really your net income. So they're 10% of the amount of the revenue of their product sales is what the shareholders get as net income. Okay. So as you can see, their 2019 numbers are, they had 59 billion in sales, and they had their cost of revenue was 51 million. So it seems like basically all of their costs are in cost of revenue. It comes down to net income of 6.2 billion. And quarterly, you can look at the quarterly to see this last quarter, COVID-19, and the comparison from the last few quarters, and you see they've had a pretty healthy, steady amount even through the first quarter, and that's very good. And their net income is even up from prior quarters, so that's a very good sign. So their balance sheet, they have current assets of 17 billion, and they have current liabilities of about 14 billion. So you see that their current assets are greater than their current liabilities, which is good. And you can see the rest of their balance sheet, which is, I mean, everything is important to look at. And I will go on to the next stock. The next stock that I have is Canon. This is not a US company as well. This is a Japanese company. And they are still traded on the New York Stock Exchange under this symbol. And here's their price. Their price is $20. And their 52-week range is $19 to $30. So they're at the very, very low end of their 52-week range, which could be a good thing. Could mean you're picking up a deal. It could be a bad thing. You have to look to see whether what's the reason for that. Is it COVID-19 related, or is the stock not doing well in general? And that's something that the chart can tell you, or the financials can tell you. You come over here and you have a PE ratio of 10 on earnings per share of basically $2 a share, so 10% of the price. And you have a very healthy dividend of 7.2% based on this price. So, I mean, that's very good. And probably the reason you generally see higher dividends on companies that are kind of, they're not growing so much. They're kind of stay kind of even. And also you'll see a PE ratio that's lower than other companies. Lockheed Martin had a 17 PE ratio, which means that people are thinking that it's going to grow. This is a lower PE ratio because it's a good company, but they don't have so much growth, as you can see here from the snapshot of their financials. So I'm going to go look at their chart. Their 2-year chart, and their 2-year chart. Let's go on this one, 5-year chart. So 5-year chart, you see it's kind of, it ran up a lot a few years ago, and then it's kind of been going down since then. This last bit over here is probably COVID-19. Let's see, yes. So pre-COVID-19, it hadn't been going down pre-COVID-19, and then it went down a lot more, and it's kind of stayed all the way near its low since then. I'm actually not sure what the news is. I'd recommend you look at the news. It could be a good buy. It could be that there's a reason why the stock is very low. But that's, you look at the chart, you combine your knowledge from the chart, from the financials that you look at, and from the news to make a decision on that, and from your belief in the product. So now I'm going to go back and I'm going to show you some of the underlying numbers. So here is Canon on FinViz, and you see their dividend, the return on investment. Okay, so their quick ratio is 1.1. And that's good as well. And their gross margin is fantastic. It's 45%. Their operating margin is 4.8%, and the profit margin, which is their net income to total revenues, is 3.3%. You can see that they've actually been their revenue has been going down over the last few years. Their cost of revenue also has been going down over the last couple of years. Well, it went up in 2018, and then it went down in 2019. And then you see their gross profit, which is very healthy, as I showed you before. It's 45% of their total revenue, which is very, very good. And then there's their operating expenses, their net income, and they do have a lot of operating expenses, so that, relative to this would be, so this would be 3 trillion, but it's actually in yen. So you see over here it says currency in JPY, which is Japanese yen. So you just have to keep that in mind when you're looking at stocks that are from overseas that report their financials overseas, that these numbers are all going to be in the local currency. So, so you look at their net income over here. Their net income has been going down over the last couple of years, and so that is something to be concerned about. And let's go over to their balance sheet, see what their balance. They have current assets of, that would be, I guess, 1.8 trillion, and Japanese yen, of course, and they have liabilities of about, current liabilities of less than that. Their quick ratio is actually not all of your current assets, as I said before. It's probably less the inventory, and but you see you have a very healthy current assets to current liabilities. Okay, the next stock we're going to look at is Schlumberger. I always say that wrong, my bad. I butcher their name. No matter how many times I try to say it, I always butcher it. Schlumberger. Okay, let's go for it. So their stock price is $18, and their 52-week range is $11 to $41, so they're pretty close to the bottom of their 52-week range. They have earnings per share of negative $13. So they lost $13 for every share which is selling at $18, which is a pretty bad number. They do have a dividend which yields 2.7% right now, and let's go look at a snapshot of their financials. So this is their revenue over the last, well, that's quarterly, let's look yearly. They've pretty much lost every single year. That's the blue is their earnings, and they've had a loss every single year. I mean, their revenue is kind of going up a little bit, but they're not doing well as far as net income goes. And I'm not sure why these quarters over here had such big losses. It could be a one-time event. You always want to check to see. Sometimes companies have big one-time events, and it's not a reason not to buy it, but of course it's definitely a reason to look into it and see what's going on with their stock. So let's look at the chart real quick. And okay, let's look at a 2-year chart. So they've kind of been trending downwards over the last 2 years, not just COVID related, way before that. I mean, they dropped a lot COVID, and they haven't really gone back up, but they were heading downwards for a couple of years already. So that's definitely something to consider, and to see whether it could be that they're going to back up, they're going to change their business and they'll do well, but you want to make sure before you buy to make sure you believe that that's going to happen, and that would take some research. Okay, here is their income statement for the last couple of years. They are they have a good amount of revenue, but as you can see, their cost of revenue is very close to their revenue, which means that, you know, incremental amounts of revenue that they're going to get is not going to necessarily increase their net income, because their expenses of selling their products is very close to the revenue that they get from those products. And they've had a huge net loss, $10 billion loss this past year. So they actually had, it looks like they had some sort of one-time event that they wrote down, maybe some assets or something. This is something that you can look into, read their actual financials, and I'm going to show you how to do that later. But you might want to look at what's going on with that stock if you're actually interested in that stock. Here's a little bit of the numbers. They have terrible return on investment. Their quick ratio is below 1. It's not terrible. Their gross margin, as I showed you before, is 12%. Their operating margin is negative 57%. The profit margin is negative 55%. Really not good. Okay, let's move on to the next stock. The next stock is Ring. Ring Central, their share price is at $279 today. Their 52-week range is 110 to 292, so they're very close to their highs. It's probably a good sign. Earnings per share is negative $1, but it's actually, if you see they lost $1 for $274, it's not a huge loss compared to their price. And here's a little snapshot. And the reason why people are buying their stock and why their stock is high is because, as you can see, their revenue is growing very quickly. Even though they don't have net income, but people are expecting them to start becoming profitable soon, and that's why they're buying their stock. So let's look at the chart, see what it looks like. Let's look at a 2-year. It's been going steadily up, and it dipped a little bit by the COVID news, but it pretty much kept going up. And it's higher than it was pre-COVID, which is pretty impressive. Now, let's look at their financials. I'll look first over here at FinViz. So, they have a very good quick ratio. They have a lot of cash, a lot of current assets over here to pay off their debts. Their gross margin is extremely healthy, 73% gross margin. Their operating margin is negative 6.6%, so they have a lot of operating expenses. It's probably because they're a growing company and they're trying to make new products and all of that. Not necessarily. You really need to look into their products and see whether you feel comfortable and like their products, as I said before. And their profit margin is negative 11%. And let's go back. Their financials. Okay, here is their financials. So as you can see, their yearly financials have been growing every single year. Their cost of revenue is growing as well, but not as quickly as their revenue is growing. Their gross profit is very nice. They do have a lot of operating expenses. I wanted to point out on this specific one, they have research and development in there. They're creating new products. And with a growing company, generally your general and admin is probably, you're going to have to hire a lot of people at the beginning to get on board new clients, new customers, and get everything labor. But then maybe later on, they're going to be just getting those same subscriptions and they won't need to service those clients. So their general and admin will go down, and they'll have the same revenue or maybe even more revenue, and which will give them a net income, a positive net income. And that's why people would be investing in a stock like this. And so you see they have a operating income of negative 45 million and a net income of negative 53 million. And that is our last stock. I do want to show you one other thing. Anytime you want to go and see the full stock, like I'll go to this last stock, you can go to sec.gov, and actually I'll go to the website and show you exactly how to get there. Go to sec.gov, and then on the top right hand corner you hit company filings. I think you can actually search directly from that box. But this gives you a fast search. You enter the ticker symbol. So I'm going to enter RNG, which is Ring, and you hit search. And what this gives you is the company's filings with the SEC, which is all their information. And a 10Q is a quarterly report, and a 10K is the yearly report. Okay, so This will give you their financial statements, but what you do get here and you don't get on most websites is you can really read their financial statements, their accounting policies. They talk about how their business is doing and what they're expecting to do, and it's really good to read this kind of stuff. If you're really investing any sort of money into a stock, you can look at what they do. It's going to talk about how they account for everything, the business expectations, all sorts of different segments that they're reporting on. They'll have different sections for all the different items that they need to talk about when you're a public company. And if you really want to know more about a stock, you can read this. It's generally very long, but they're going to talk about all sorts of things in here and show you all sorts of numbers that you can't get on Yahoo Finance or any other website. All the different metrics, and where their company is headed and how they're doing and all of that. Thank you very much. I'm going to include links and descriptions in the bottom. Thank you very much for watching my video. If you'd like me to review more stocks, please let me know what stocks you'd like me to review. If you like this video, please like and subscribe and share it, and I really appreciate it, and we'll see you next time.